Yes, sir.
Yeah. These areas we already discussed. Yeah, so we have to start from here. Target profit. In the last class, we talk about break-even point, margin of safety, and now we we'll discuss to achieve a certain profit. To achieve a certain profit, how many units should be produced? Right. So earlier we talked about break-even point. Break-even point. So here there's no profit, no profit, no loss. Right? No profit, no loss. So that is called break-even point. And margin of safety also we discussed. Margin of safety is the difference between the budgeted sales minus break-even point. So it can be expressed in terms of numbers, value, and also in percentage. Now we'll see target profit. A company sometimes may have a target, say the next budgeting period, they have to make 50 million profit. 50 million profit. So it's mean here to achieve this 50 million profit, how many units has to be sales made? How many units has to be sold out? So that kind of target. So how we can do this? A similar formula may be applied where a company wishes to achieve a certain profit during the period, right? Certain profit during the period. To achieve this profit, sales must cover all cost and leave the required profit. Normally, to achieve break-even point, right? To achieve the break-even point, where the fixed cost should be covered by the contribution, right? Should be covered by the contribution. So in this point, we achieve break-even point, right? So fixed cost and the contribution. Contribution mean selling price minus variable cost. Selling price minus variable cost equal contribution. So this contribution should cover fixed cost. So that is break-even point. Now we need to cover. So in right to achieve a certain profit target, we have to cover both, right? The contribution, right? The contribution should cover fixed cost plus the target profit. Then we can achieve that profit. So number of units, right? Number of units. So this is the target profit here. The target profit is achieved. The target profit is achieved when sales, right? The sales value should cover the variable cost, fixed cost, and the target profit. So if sales cover variable cost plus fixed cost, this is the point, break-even point, right? So the sales value covers variable cost and fixed cost, right? Sales value minus variable cost equal to what? Contribution, right? That contribution should be equal to what fixed cost, then BEP. So this is in other words, right? Here S means sales, V mean variable cost, F mean fixed cost, required profit. Here we subtract the V, which means variable cost, from each side, what we call, right? So when we write here, this is contribution. When we deduct variable cost from sales, we got contribution. This is contribution. And we subtracted V, so no more V here. Then the contribution should equal to fixed cost plus target profits. So therefore, total contribution required to make target profit, right? Total contribution to make the target target profit equal fixed cost plus target profit. This is the formula, right? So you can understand this thing very easily. RB Co make and sells, right? Makes and sells a single product for which variable costs are as follows. Variable cost include direct material cost 10,000, direct labor 8 rupees, 8,000, and variable production overhead 6,000. Altogether, the variable cost equal 24. Right? Very careful. This cost should not include. Right? We are talking about marginal costing. So therefore, we should not consider fixed cost. Sometimes they may include total production overhead. The total production overhead include both variable overhead plus fixed overhead. Don't include fixed overhead here when you calculate contribution, right? The sales price 30,000, right, per unit, and fixed cost per annum 68 million. The company wishes to make profit of 16 million, right? From this data, we can see that the sales value, the selling price per unit 30,000, and the variable cost equal 24,000, and the contribution equal how much? 6,000. Contribution equal 6,000, right? At this moment, how we can calculate the break-even point? How many units has to be produced? How many units has to be produced to achieve break-even point? The formula is break-even point equal fixed cost divided by contribution per unit. In this case, the fixed cost is 68 million, and contribution per unit is 6. Then how much? Break-even point here, how much? Someone else, can you help me?
13,000.
13,000, isn't it? Is it this value? Okay. 30,000 units. Here, the company has no profit, no loss. I will do it in Excel so that we can understand easily. Here, selling price per unit, variable cost per unit. Then we can get the contribution. After that, we can deduct fixed cost and profit. Here we can put the unit number of units. Number of units. Here selling price is 30. Variable cost is 24. Variable cost 24. Then contribution equal this value minus variable cost equal 6,000. Fixed cost equal 68 million here. 68. We cannot put here, right? 68 million. 68 million. Right. We'll see the profit. So we have already counted that the BEP, right? Break-even point equal fixed cost divided by contribution per unit. Fixed cost, right? contribution point is 6. No? $68 million. So this the certain value will get it. So number of units here, it's equal to this VP. Let's see. Then total contribution could be this value into this contribution per unit. You see 68, right? 68 million. Contribution equals 68 million. Fixed cost 68 million. And the profit equal, right, 0. Right? So break-even point is this. Break-even point is this. Now, right, now the question is, the company wanted to make here, so it should not be right. This is wrong answer. This is incorrect answer, right? Then company wishes to make a profit of 16 million per annum. Yeah, right? Yeah, to cover, right? To achieve the break-even point. This means no profit, no loss. The company should cover fixed cost, right? If the company cover fixed cost, no profit, no loss. Here, contribution. This contribution cover its fixed cost. Here, no profit, no loss. Right. So that to cover the 68 million, right, the 16 million profit, what we have to do, what they have to do, they have to at a target profit of the 16 million. 16 million has to be added so that they can achieve the target profit. Now, units required to achieve the target profit. Here, 16 million, no? 16 million, right? They have to achieve 16 million profit. 16 million. Right? 16 million. They have to achieve million, right? So, right. So normally, as we already discussed, to achieve the 16 million, right? To achieve the 6 million, so normally as again I explain you the formula, right? The basic fundamental. How do you calculate? Always you have to bear in mind sales value minus variable cost equal contribution minus fixed cost equal profit, right? To find the contribution, what we can do is we can add fixed cost plus profit, right? If we compare these two, right, then we can get the contribution, right? When we add the variable cost with the contribution, we can arrive sales value, right? So we can go forward and upwards, right? Downwards and upwards. So whenever we need, we have to decide here. So we have to make 16 million profit, right? Fixed cost, no changes. So that we can get the contribution, we should take the contribution, this value, fixed cost for, right? They have to cover 84 million to make a profit of 16 million, right? To make 84,000 contribution, how many units they have to make? How many units they have to sell, right? What we can do is, so this is a contribution, no? It's a contribution. Contribution per unit, 6. So therefore, they have to produce 14,000 units, right? They have to produce 14,000 units to achieve the target 16 million profit. 16 million profit. Is it clear? We can verify the answer. We can verify. You see here, selling price 30 into 13 into 14,000 equal total sales is 420 million. And for variable cost, 14,000 units into variable cost equal 336,000, and the contribution will be selling value, sales value minus total variable cost equal this value, and there is no changes in the fixed cost 68, and therefore the profit will be contribution minus fixed cost. Contribution minus fixed cost equal 60, right? So when the company make 14,000 sales, they can produce 16 million profit, right? So this is one way. This is one way. By applying the CVP analysis, by using the contribution, the formula, we can directly find this. How? Yeah, the formula is the formula. The formula required, right? The target profit units equal fixed cost plus target profit divided by contribution per unit. Here fixed cost 56 million plus target profit 16 million divided by contribution per unit 6,000, right? 6,000. Then when you solve this formula, we can get 14,000. We'll do it, right? The fixed cost 68,000 plus target profit 16, right? It should be divided by, sorry, it should be divided by contribution per unit. You see, we get the same value, 14,000. So here we get 14,000 units, right? So this is one way. And also you can directly find the sales value. The thing is to find the target profit in terms of value, right? In terms of rupees, right? In terms of rupees, instead of putting contribution, you have to use CS ratio. When you apply CS ratio, you can get the target profit in terms of rupees, in terms of value. Here, the selling value is 30, and the variable cost is no need variable cost, and the contribution is 6. Contribution is 6. Then how much the 1/5, right? So when you divide this value over 1/5, then we can get the target profit in terms of rupees. Say here we can apply here, and now we find the CS ratio. The contribution sales this contribution is this. So this is CS ratio. This is CS ratio. Right. Now we need fixed cost plus profit divided by CS ratio is here. CS ratio. Then we get 420 million. See here, these values, sales value 420, 420. Is it clear? Is it clear? You see here, the solution required contribution equal fixed cost plus target profit 68 million plus 16 million equal 84 million required contribution. And here 14,000 units and 420 million in revenue. So they have applied two methods, one this method and this method. I have given you another method. So that is this. So this is also another method. You can think logically without remembering the formula. Right? Is it clear? Make sense? Make sense? Imran, is it clear? Okay.
Yes, sir.
Okay, good. Yes. Now let's move. So we can do this thing, right? So the same, right? The same, the same to find out the target profit. It is not a new thing here. Right, variations on a break even and profit target calculation. How do we do this variation? Sometimes price may varies, or selling price may vary, or variable cost may vary, fixed cost may be varies. So based on the market condition, some variables may changes. We are talking about the budget, the future. In the future, many things may happen. Then how we can apply these changes within this break-even point analysis. You may come, right? You may come across variations on break-even and profit target calculation, in which you will be expected to consider the effect of altering selling price, right? You may have to alter the selling price, altering the variable cost per unit or fixed cost. So anything may change in the future. If this kind of changes occur, how do we incorporate? Let's see. ST Cakes Limited, right? Liability limited company, bakes and sells a single type of cake. The variable cost of production is 150, right? We have to take this value, variable cost 150. And the current selling price is 250. Selling price 250. Fixed costs are 2.6 million per month. It is month, right? Not the 2.6 million per month. And the annual profit, annual, here they are talking about month. Here they're talking about annual. The annual profit for the company at the current sales volume is 36 million, right? The current profit, right? The current profit for the company at current sales value is 36 million. The volume of sales demand is constant throughout the year, right? This is the basic data, right? When we convert this annual profit into monthly profit, so 36 million should be divided into 12 months. 12 months. Then monthly profit could be 3, right? 3 million. 12 into 3, 36, 3 million, right? So monthly profit 3 million, because here they gave us 2.6 million monthly fixed cost. The sales manager wishes to raise the sales price to 90. Now they are going to change the selling price from 250 to 290. So when they increase the selling price, there will be a loss of sales. So there will be a reduction in the demand when price go up, and consequently sales volume, the demand goes down. But consider that price rise will result in some loss of sales. The question is, calculate the minimum volume of sales, right? Calculate minimum volume of sales required each month, right? That each month to raise the profit, sorry, raise the price to 260, 290. The thing is, right? Currently, they are earning 3 million monthly profit. 3 million monthly profit. When the selling price was 250 and variable cost 150. Now they decided to increase the price to 290, and they're considering that when they raise the selling price, there will be a drop in demand. Anyhow, they are not ready to compromise on the profit. They are not ready to compromise on the profit. Anyhow, they have to make same profit as they make in the last month. Right? So the target profit here, the target profit is 3 million. In the short term, no changes in the fixed cost. No changes in the fixed cost. Therefore, the fixed cost is 2.6 million. 2.6 million. Right? So therefore, to earn the same profit, they have to make contribution of 5.6 million. They have to make 5.6 million contribution. But the thing is, earlier contribution was here selling price 250 and variable cost 150. The contribution was 100. Now selling price goes up to 290 and no changes in the variable cost is still 150. So therefore, new contribution is 140. New contribution is 140. So therefore, the expected contribution to achieve the 3 million target profit for the month, they have to divide this 5.6 million by 140. 140. Then we will work out on this. We will work out. Here, selling price 290, variable cost 150, and contribution is 140. Right. They want 3 million profit and 2.6 million. So this is 5.6 million. Right. Now let's see how many units they have to make. How many units they have to make. Here, break-even point will be 14,000, right? 290,000. Yes. The break-even point will be, yes, break-even point, fixed cost. Sorry, break-even could be this.
Figures should be changed. Huh?
Yeah, we have to add together, right? Wait, I'll do here. So they have to make profit of this by contribution per unit is 40, right? They have to make 40,000, and they have to make 40,000 units. Okay, yes. When we divide this 5.6 million, 5.6 million divided by 140 equal, we will get 40,000. So in that point, no profit. Sorry, in that point they can earn 3 million monthly profit. So we can verify that, right? We can verify, right? 290 plus 150 minus equal 140. 140 into, right? 140 into 40. Here, this one. 40 units into 140, you will get 160, 2.6 million, 2.6 million fixed cost, right? When the profit will be minus, you see 3 million, right? 3 million profit, right? So now we look at the changes in the selling price, and there are a lot of changes in the variable cost, material price, fixed cost, and so on. Changes in production cost. Changes in production cost. The CV LLC make a product which has a variable production cost is 8,000. Variable cost 8,000, and the variable selling cost. Variable selling cost. Here variable production cost is 8, but variable selling cost is 2. So therefore, how much total variable cost? Variable cost, total variable cost include this 2, right? Variable cost. Yeah, this is production variable cost. This is sales cost per unit. So therefore, total variable cost per unit is 2,000. Sorry, 10,000. Yes, 10,000. 10,000. Fixed costs are 40 million per annum, and the selling price 18,000, and the current volume of output sales is 6,000, right? 6,000, that is the case. Right, now we move to the next slide. So I can delete this. Right, current sales unit is 6,000 as the given, and the selling price 18,000. Sorry, yeah, 18,000, and 40 million. 18,000, and the variable cost 10,000, and the contribution is 8,000. Fixed cost 40 million. Fixed cost 40 million, right? Fixed cost 40 million. Now let's see the contribution now. Present contribution, present profit. Present profit could be a contribution per unit into number of units of production. Then we calculate the profit equal contribution minus fixed cost equal, right? This is 80 million profit. They are making 80 million profit. 8 million, right? 48 million. 1, 2, 3, 4.8 million. Fixed cost 40 million. Fixed cost 40. 1, 2, 3, and 1, 2, 3. And so 80 million. It should be 80 million, right? 8 million. Right. There's some issues here. 6,000, no? 6,000 units, 10,000, 40 million. So there may be error in the book. 6,000 selling price, variable cost, and contribution. And this is total contribution, right? We did cut three zeros. 40 million, right? Profit will be 8 million, right? Profit will be 8 million, right? The book is correct, right? 8 million. Now the company is considering whether to hire an improved machine for production. Annual hiring cost would be 10 million, and it is expected that the variable cost of the production falls 6,000 per unit, right? Earlier, existing variable cost of production is 10,000, no? But 8,000. It's 8,000. The existing production variable cost 8,000. Now they are considering to enhance the production capability. So therefore, they wanted to fix a 10 million fixed cost machine. So by doing so, they can reduce the 8,000 variable cost into 6,000 production cost, right? The variable cost of the production. So right, then it means 10 million additional fixed cost due to that reduction in 2,000 variable cost. Calculate the number of units that must be produced and sold to achieve the same profit as the currently earned if the machine is hired. Right? If the machine is hired, right, the decision that we are talking about short-term decision, right? Short-term decision. You look at the assignment, right? We are looking at the assignment. Critically analyze short-term financial decision-making process relating to price, right? Price changes, cost changes, output, number of units, output, building on small model, that break-even point, margin of safety, and contribution at the base case, and one changed, right? Price changed or cost change. Now we are talking about price change. In the second part, we will talk about relevant cost. Relevant cost, I will come later, right? So we are talking about now this area. Short-term decision. Right. Now we have to decide how many units has to be produced to maintain whether are you going to hire the machine. If we hire the machine, what could be the target profit or what could be the break-even point? So that kind of issues. Short-term profit. Right. The number of units, calculate the number of units that must be produced. That must be produced and sold to achieve the same profit of 8 million earned the current machine, right? Now what will happen? And we have to find this, right? So target profit, our target profit is what? Same 8 million. Same 8 million we have to produce. And there will be a changes in the fixed cost. $10,000 means 10 million should be added. So therefore, fixed cost will be 50 million, 50, right? Then how much they have to earn this? Contribution could be 58. They have to make 58,000 contribution. At the same time, the variable cost. Now the variable cost could be already 8,000 production variable cost due to the introduction of the new machine. The variable cost may go down. So therefore, now it will be 8. Why? Already it was 10, 2,000 reduction, right? Selling price, no changes in the selling price. And the contribution here, contribution could be 10 rupees, right? 18 minus 8. This is contribution per unit. Now let's see the number of units to be produced. So 58 million divided by 10 contribution per unit. Then they have to produce 5,800 units. 5,800 units. 5,800 units. So they have explained in different way. The current contribution, the current unit contribution is this 8,000, and current contribution and current profit is 8. New machine and so on. With new machine and fixed cost will go up by 10 million. So that 50 million new fixed cost. The variable cost per unit will be fall to 8,000, and the contribution per unit will be 10,000. So record profit 8,000, fixed cost 50, and the record contribution is 58. The contribution per unit is 10,000 new contribution. So therefore, when they divide this 58 million by 10,000, they will get 5.8 thousand units. Right. The next question. Next question. Calculate the annual profit with a machine if the output and sales remain at 6,000. Right. No changes in the sales. Right. Assume that 6,000. What will happen? 6,000. Now we have to change it into 8. Then new contribution 10. And then total contribution is 60. And here it will be, we have to increase. We have to increase by 50 million. And they can make how much? 10 million profit. If the current sales, they can make 10 million profit. You see here. If sales are 6,000 units, right? Selling price no changes, sales value no change, so therefore 8 million sales. Variable cost could be 48 million, contribution 60, fixed cost 50, and profit 10. Alternative way, profit 5,800 sales 8, contribution from sales to extra 200 units, right? So we already found for 5,800 units, we already found the profit could be 8. So to additional sale 200 mean to achieve 6,000, they have to increase by 200. No, we already know, right? Contribution per unit was 10,000 per unit, then 200 units. So therefore, at 2,000, and sales profit at 6,000 units could be 10 million. So this is another way. So in here, when you write the assignment, you have to write some of the data you have to insert in your case. Then you have to solve it. The thing is, in your assessment, in one question, you have to accumulate all this data, and in that way, you have to make the case. It may be clear by now that even no change in fixed cost, no changes in fixed cost, total profit is maximized, and the total contribution is at maximum. The total contribution in turn depends on the unit contribution and sales volume, right? There are two things. The contribution will depends on two. One is variable cost. Another one is selling price. Another one is number of units. These two, right? Variable cost and selling price will impact on contribution per unit, while the number of units produced or sold will impact on total contribution. Total contribution. But the meanwhile, you have to consider that fixed cost, no changes, right? No change in fixed cost. By keep in mind, we'll see how companies make kind of decisions. An increase in sales price will increase in unit contribution, but sales volume is the likely to fall because the fewer customers will prepare to pay for higher prices. A decrease in sales will reduce the unit contribution, but sales volume may increase because the good offer now cheaper when they reduce the selling price. The optimum combination of sales price and sales volume is arguably one which maximizes the total contribution. Right? Whatever you make decision you can make, but the thing is the objectives, right? Objective in a short-term decision, you should maximize their contribution. Let's see the profit maximization case. T LLC has developed a new product which is about to be launched on the market. The variable cost of selling the product is 12 per unit. It is variable cost of selling. The marketing department has estimated that the sales price will be 20, right? However, if sales price set to above 20, sales demand will fall by 500 units. For each 500 in right now they found the break even, right? No, not a break even. They found this 20,000 rupees as a base price. 20,000 rupees as base price. And at this point, they can make 20,000 units. 20,000 units. And they argue that when they set the price above this 20,000, say 20,500, 20,500, the sales drop, right? Sales drop by 500 units. It's been 19,500. Same time, similarly, if the price is set below 20, the demand will increase by 500 units, right? Say 19,500, 19,500. Then they can increase the sales by 20,500 each step in the reduction in below 20,000, right? This is the case. The question is, calculate the price which would maximize the C company's profit in the next year. Sales price 20 per unit. So the thing, right? Sales price is 20 per unit, and the unit contribution will be here 20 rupees, no 20,000 rupees selling price. 12,000 is a variable cost. Therefore, the contribution is 8. Contribution is 8,000. Contribution, unit contribution is 8,000. Current selling price 20,000, right? 20,000 unit price. So their sales volume, current sales 10,000 units. The total contribution could be how we can find 8,000 into 10,000. It could be 80 million, right? This is the base. This is the base, right? Each 500 increase or decrease, each 5,000 increase in price would raise the contribution by 500, right? See here, when they reduce the price, from 20,000 to 19,500, right? So if they reduce 500 rupees, this is 1,000, right? In thousands. When they reduce by 500 rupees, right? 500, it's become 19,500. the contribution will be low, right? So because there's no changes in their variable cost, no changes in the variable cost. So therefore it's become 7,500. And unit sales increased by 500, no, 500 units. Say earlier 10,000, now increased by 500. Now you see the total contribution 78,000. So when they reduce the selling price, sales volume increases, but total contribution reduces. Even more, if they reduce the selling price by another 500 rupees, contribution got lower, selling number of units increases, and they able to make 77,000 a contribution. And even worse case, right? Earlier 78, now 77. Right. Now we look at the increase of the selling price, Right. From the base 20,000, the increase the selling price by 500, and contribution also will increase by 500 units, 500 rupees. So therefore 8,500. Now sales got dropped from 10,000 to 9,500. So when they multiply these two, they will get 80,750. Even more, they increase the selling price, right? Contribution increase, unit fall down, and contribution is 81. Further increases this value, this value, this value. From this, can you tell me, so what is the ideal selling price for that product? What is the ideal selling price that maximizes profit, maximizes contribution of the organization? Which one? How much?
21,000.
21,000. Why? So when we look at these contributions, right? Contribution, when we set the price at 21,000, give us maximum contribution. So therefore, the total contribution will be maximized, and therefore profit maximized at the sales price is 21,000 per unit, and sales demand is 9,000. Even though it drop the current sales, they can maximize their profit. This is how in the market, in the real market, marketers increase the price. In surface level, we think by increasing the price, the product sales unit goes down. But the company's point of view, they do this kind of calculation and they maximize the profit. This is how they fix the price. When they increase the price, definitely there will be a drop in sales, but the comparatively profit got maximized by sacrificing few such customers. So this is the strategic decision, right? Because the company's objective is to maximize their profit, maximize their wealth. So also you can do it by yourself. So here in this question here, selling price is 28, variable cost 13, a fixed overhead this amount. The break-even point was calculated using these figures, but the management have decided that variable cost, now the cost increase. So therefore, selling price also increase. You see, the cost increased by only 1.9%, but selling price increases 5%. You see, for example, in the real case, the egg price falls down, right? the marketers will never reduce their price of cake or price of any other items produced based on the egg. But when there's an increases in the small increase in price of egg, definitely quickly they will incorporate, they will increase their price. Right? Say the egg price from 20 to 22 rupees increases. Then the kottu makers and the cake makers will increase the selling price of the cake 500 to 600 rupees. Right? When we ask why, there's an increase in their material cost. Like what's that? The egg. This is what happened. So when price increases in the market, input prices increase in the market, we can see there will be a huge inflation in the country because of this. Small changes in the prices of material will make a huge impact on the inflation, because marketers, the corporate, the companies try to maximize the selling price so that they can maximize their profit. Comparatively, during the period of inflation, companies will make huge profit. Companies make huge profit. During the financial crisis, right? Anchor, another milk powder price was only 320 rupees, and they argued, they stopped import of milk powder. Because of that, the dollar got increased. How much that time in 2022? The dollar is about 108, right? That time it milk powder is 220 rupees. Now later, the dollar fixed to 360 rupees, 360 rupees, right? But they increased the milk powder to 1,050 or 1,250 rupees. How many times? Almost 4 times. 4 times. Here, dollar, the currency devalue only by 2 times. Again, the dollar became 300 rupees, but selling price drop only just 150 or 150. So how much reduction they did? So this is how the marketers always try to maximize the opportunity, right? So always this is the case. That's why in European countries, in Western countries, the government is serious. Government pays serious attention on increasing the selling price, increasing their material prices. So in our countries, inflation rate always in this number: 8% inflation, 12% inflation, 6% inflation, right? Into 2022, the government reported 77% of inflation. But actually, when we look at this kind of things, it could be 300,000, 300% almost. But government reported only 77%. But when you look at the Europe, the inflation rate is like this: 0.01, 0.02, and 0.1 maximum. Right? So in the decimal point, but in our countries, inflation in this. So that's why they are having the good standard of living, so higher level of standard of living. Right? Government pay serious attention on material prices. And the same vein, right? This is out of case, that is economics, right? But as a marketer, you should know you should know how the marginal increment in the material prices, it make a huge impact on the inflation overall economy. You see here, 1.9, right? Material price rise 1.9, and selling price, due to that they can increase by 5%. Calculate the break-even point when the new cost and the price are taken. Here earlier selling price 28, now it's increased by 5%, so therefore 29.4, 29,400. Variable cost earlier 13, it's increased by only just 1.6%. 1.6%. Now the selling price, now the variable cost is this, and contribution could be earlier 15 into 16.5. Let's see the changes. Let's see the changes. The break-even point earlier it was 105, right? Earlier break-even point is 7. Now break-even point 6,500. How do they calculate the break-even point? Fixed cost divided by contribution per unit. So this is how contribution 7,000 units. Here contribution 500. Here you see the changes. Earlier 7,000, now 6,500. Base value 7,000. Now see break-even point increase, reduces by 7.14. You see how marketers earn profit. Always marketers would win. Even though when they increase the price, right? Always marketers wants that material price has to be go up. Then they can get the multiple profit. Here break-even chart, right? Break-even chart. No break-even chart. Normally you can, right, by looking at this book, we can draw, right? So I just give you small explanation. So how do we draw the break-even chart? Break-even chart, break-even point, right? Break-even chart. Here we have to take values, right? Rupees, and the horizontal axis we have to take units. And to draw this kind of break-even point chart, we need fixed cost. We need fixed cost, and when we need variable cost per unit, and selling price per unit, right? To draw a line, at least the minimum, we need 2 points. We need 2 points. When sales is 0, right? When sales or production is 0, the fixed cost always fixed. So we get 1 point. We get 1 point. Even though the production is 100 or 200 or 500, it never change. So we can write fixed cost line. It's straightforward. First step, we draw the fixed cost line. Second, we know that sales is 0, right? When the production is 0, no sales, and no cost, no variable cost, right? When production is 0, there is no variable cost, there is no sales. As far as the cost side, the variable cost, we take this cost side 0, and at the production 0, we have total cost equal to fixed cost, right? Then the variable cost plus fixed cost equal total cost. No, total cost. The fixed cost will never change. And once we know the variable cost, say variable cost per unit is 5. Variable cost is 5 rupees. Then we know that 1 point they are making 120 needs. So we can find very quickly 5 into 120, that could be variable cost, and fixed cost there are no changes. Then we can get the total cost. So that point is here. Here we got the point. Here point 1 and point 2. Then by connecting these two, so we can draw a line. So that line represent total cost. Total cost. Already here we have drawn fixed cost line, total cost. Right. Later we get selling price per unit, say 10 rupees. 10 rupees per unit. 10 rupees per unit. Now, when the company sell 120 units, it is straightforward. 10 into 120, we can get this value, this point. We know that at selling price 0, at number of units 0, no revenue, no sales. So we have 1 point, so another point, and we can draw this line, right? So this is called sales. Called sales. Now, when we draw this line, this point, these two lines intersect a point. This point called break-even point. Break-even point, right? So 80 million here, when we take this line here, this is 80 million. It's a break-even sales. Break-even point sales. This is break-even units. Break-even point units. If it is, this is an actual sales, right? You know this. So here, when you here look at here, the total cost is this line, and this is total sales revenue. So the point below this break-even point, this is loss. Loss. Point above here, the area of this triangle represent profit. If it is 120 is actual sales, and we already found 80 is a break-even point, the difference is margin of safety. Margin of safety. And this is total budget fixed cost. This is budgeted variable cost. Budgeted variable cost plus fixed cost equal total cost. The area is total cost. Total cost. And this is total revenue. Total revenue minus total cost equal budgeted profit. Budgeted profit. So this is called break-even charge. Break-even charge. And also there are one more chart here. It's called contribution break-even chart. Contribution. So in the contribution break-even chart, we are not worrying about the fixed cost. We are not worrying about fixed costs. Fixed cost here at production or sales 0. No sales, no contribution. No sales, no contribution. In 120 units, so to find sales, and we can draw this line. We can find the sales value. We can say you can draw the line. And the variable cost, say 50 rupees or 5 rupees variable cost into 120. And then here selling price 10 minus 5 equal contribution equal 5. 5 into 120. Then you draw another line, contribution line, or directly you can draw the variable cost line. Variable cost. A production 0, 0. And when production is 120 into 5, then you can find this variable cost. Variable cost. So this is sales. This is sales. The gap is contribution. The gap is contribution. If you want to find the profit, you see budget contribution, this area. If you want to find the profit, then you have to add fixed cost. We don't want to draw the fixed cost line here, right? We don't want this one. Rather, what we can do is, we know that fixed cost is always fixed. To find the total cost, what we do is, we at variable cost plus fixed cost. Then always the total cost line and variable cost lines are symmetric, the parallel lines. Those are parallel lines. Those are parallel line. The gap is parallel, right? Always equal. So and this point is a break-even point. Right? So this is above profit, below loss. Likewise, this is margin of safety. This is another chart. And here one more chart. This is called PV graph, profit and volume. You see here, you can see plus profit plus. We are right here. They are taking profit, the loss here. So first point, we take fixed cost, because at production 0, right, at number of units 0, always there's a cost, there's a loss. That loss equal to fixed cost. So we know 1 point. You know 1 point. Another point here, we calculate, say 120 units of sales. We calculate contribution and we deduct fixed cost, then we will get profit. We will get profit. Right? Say 120 units, we get profit at this number of profit. Then we have two numbers, 2 points. We connect these 2 points using a straight line. Then it will cross. So at this point, profit is 0. The crossing point, right, is called the break-even. So at this point, break-even profit, break-even point. So this is called what? This is called PV graph. And we can read this book and we can find out many things. Right. So the next section could be contribution per limiting factor, right? Limiting factor and optimum production. Right. In your assignment, it's also talking about limiting factor, right? You see, limiting factor analysis and make or buy back, right? So we have to move in that aspect. Where we have to talk about relevant cost. We are relevant at the limitation, right? You should read some notes, right? What are the assumptions of break-even point and limitation of break-even point, right? So that the next session, and after the break, we will talk about, we'll discuss about the limiting factor, right? Limiting factor decision by make or buy decision. Right. Shall we meet about 10:30? We'll meet about 10:30. Before that, if you have any doubt, please, if you have any doubt, we can ask.
Excuse me, sir. Do we use
Any doubt?
yeah,
Yes.
do we use any word instead of contribution? It's like gross profit or something like that.
I couldn't get Imran.
We use contribution, right? Contribution.
Yeah, we use
For
contribution.
that,
Yes.
yeah. Do we use any other word like gross profit like that?
No. So we use only this term contribution only. Profit mean contribution minus fixed cost equal profit.
Yeah. No, gross profit not relevant to this.
No. So right, very good question, right? Very good question. He is talking about he made got confusion because of this. Okay, right, it's a good question. I'll explain you. Here in the marginal costing, we talk about what? Contribution and profit. But when we study accounting, we talk about gross profit and net profit. Imran, are you talking about contribution equal gross profit and profit equal net
Yes.
profit?
Yes.
Both terms are equal or different? Is that your concern? No?
Yes. Yes. Yes.
Yeah, right. Here the marginal costing, right? In the marginal costing, we assume short run and long run, right? Or long run. It's assumed that in the long run, in the short run, there are two kind of cost. One is variable cost, and the one is fixed cost. In the long run, all costs are variable cost, right? All costs are variable cost. Therefore, we couldn't consider anything here. So we are discussing about short run now. The short run. So we have to classify in the short term decision. We have to classify the total cost. We have to classify the cost based on the behavior, based on the classification of cost. Can you remember? In the first class, we talk about classification of cost. Classifying the cost based on behavior. Behavior we divided into two. One is variable cost. Another one is fixed cost. Another one is semi-variable cost, like this, or like this, or sometime like this, isn't it? Remember, right?
Yes. Yes.
So when we talk about the short-term decision, we are classify the cost based on uh, cost behavior, classify cost behavior, right? And also classify the cost based on elements, cost elements. How do we classify the cost based on the elements? Direct material, sorry, material cost, labor cost, and variable cost. So not variable cost, overhead cost, overhead cost. Material cost again we divide into uh, direct material and direct labor. Sorry, direct material, indirect material, indirect material. Labor cost also direct labor, indirect labor. Overhead also direct overhead. Sorry, variable overhead and fixed overhead. So all direct cost, direct, and this, all these things are variable, right? Variable, and this is fixed, and this kind of things are considered as an overhead, right? Indirect, all indirect considered as what do you call it? Overheads. All direct costs are uh, direct cost. Rest of the things are variable, right? We classifies this kind of thing in the short-term decision, but when you find the gross profit and the net profit, you classify the cost based on the function. Classify the cost based on the function. Based on the function mean here production function, admin function, right? Selling and distribution, and finance and the cost, right? You know, in the production. So when you do financial accounting, profit loss accounting, right? Profit loss accounting, you arrive, right? Here, production cost, for example, production manufacturing, right? Manufacturing cost, you may add production cost. production cost, right? Production cost. After that, sales. So sales minus production cost equal what, Imran? Sales minus production cost,
Gross profit.
gross profit, gross profit. And after, from the gross profit, we add other income, then we deduct admin cost and selling and distribution cost and finance cost. After deducting that, we receive what we get, balance figure,
Net.
net profit, right? Here, when we, right, when we consider this cost classification, right, production cost, the production cost may consist of two types of cost. Here, production cost include direct labor, right? Direct labor, direct material, indirect labor, right? Indirect material, and so on. Admin, all cost, admin, most of the costs are what do you call, not relevant to the production. Most of them are what do we call, most of them are overhead. Most of them are overhead and selling and distribution overhead. Again, within this selling distribution cost, there will be two. One is a fixed cost, another one is variable cost. Say sales commission per unit, sales commission per unit is variable or fixed?
Fixed.
No, say 50 units. If a salesperson sold 50 units and 100 units, this is A, this is B, sales rep A, sales rep B, who will get more commission?
B.
Why is a fixed or variable?
Yeah, variable, right? It's number of
When
units into
when he sold many number of units, right? Many number of units, he will get more number of he will get higher amount of commission. It's a variable cost. It variable cost, right? And depreciation of sales van vehicle or rent, showroom rent, variable or fixed?
that is fixed.
Showroom rent,
Fixed.
it's fixed. Whether you make sales or not, you have to pay the rent. Then in the production, right, direct labor is variable or fixed? Direct labor per unit, 5 rupees, 1000 unit production, then 5,000. If he produce 10,000, then he will get in that way. So this is variable.
Variable.
Yeah, in the machine cost
That
or
is fixed.
the factory cost, the factory
Fixed.
rent is fixed. And when you look at here, production cost has two types: variable component and fixed component. Admin, variable component, fixed component. Selling, variable component and fixed component, right? When we do this kind of accounting, this is called what? Financial accounting, right? We classify the cost. Based on the function. That's why we did a production, admin, selling and distribution. These things are function. So we arrive gross profit and net profit based on the cost classification. What is the cost classification? We classify the cost based on the function. But in marginal costing, in short-term decision, we classify the cost. Based on what? Behavior. Based on the behavior. In the short-term decision, right, I will teach you the relevant cost. The short run, variable cost, they divide the cost into variable and fixed cost based on the behavior, right? And short term decision, we assume that fixed costs are irrelevant cost, irrelevant cost, right? So now you can understand that contribution and profit is not equal to gross profit and net profit, because we are in the short run, we use marginal costing in calculating gross profit and net profit. We use absorption costing. So these two are two different approaches, right? So Imran, now tell me, contribution equal to gross profit. Is contribution equal to gross profit?
All right.
No. Profit is not equal to
Gross profit.
net profit.
Net profit. Yeah.
It's two different approaches. Here, in this module, we are talking about management and cost accounting. That's why in the very first class, we discuss the differences between financial accounting, cost accounting, and management accounting. Budgeting, right? Budget, variance analysis, CVP analysis, that marginal costing, comes under management accounting. For determining material cost, determining labor cost, determining overhead cost, right? Say FIFO, LIFO, Halsey-Ware, Rowan, right? So these kind of things are coming under and but EOQ, economic order quantity. These kind of terms related to cost accounting, right? Cost accounting, process costing, batch costing, job costing, right? All these things are related to cost accounting. So now our focus is on what? Management account. Right? As a manager, you have to take decision strategically. Make sense? Clear, Imran?
Yeah. Yes, sir. Yes.
Okay.
Management.
Then any other questions? Any other questions? Okay, let us meet. About 10:40. Okay, let us meet on 10:40. So she wanted me to take attendance, so that I take a screenshot at this moment. Okay, we will meet at 10:40 or 45. 10:40, we will come at 10:45. So we start session. Okay. Okay. Right. Contribution per limiting factor and the optimum production mix. Right. Production mix. For this, I would like to. So this is little complicated. Not complicated actually. This is CE Sri Lanka, so therefore it's little hard to understand. So that I take this handout. Limiting factor analysis. It's come under short-term financial decision. Right here, short-term decision making. Right, short-term decision making. The short-term decision making. Right, actually, we talk about the break-even point, the margin of safety, target profit, such kind of things. It's a fundamental, right? So we need to understand the fundamentals. Actually, we move now at this moment. We will formally introduce short-term decision. In the short-term decision, we should know about relevant cost. What does it mean? The relevant cost. Relevant cost mean, so whatever the costs are relevant, whatever the costs are relevant for making decisions. Some costs are not relevant, some costs are relevant, right? So it's very important to know what are the relevant costs are. Here, the cost should be used in the decision making is called relevant cost. So whatever the costs are relevant for the decision, that is called relevant cost. Accordingly, relevant cost can be described as the cost, described as the cost that is specifically incurred so as to take some management decisions. We can't take all their cost when we take decision. Hence, two costs can be identified in short-term decision. One is incremental cost and opportunity cost. Incremental cost, you see, incremental cost sometimes we call as a marginal cost. Marginal cost, right? Marginal cost. What does mean marginal cost? We take decision A. Already we are in the process of A, right? Now we have to decide either we move to plan B. Plan B. It's a decision point from A to B. Already, when you are running, implementing plan A, your cost is 1,000. The cost is 1,000, and revenue could be 1,500. Here, profit is 500. Profit 500. Now, the management has to decide either we move to plan B or stay plan A. Right? So when we move to plan B, right? to move to switch from A to B, it incurs additionally 300 rupees. 300 rupees, right? 300 rupees. And sales price still same 1,500. Now the profit is how much? 200. Now tell me, do you move or not? Do you move or not? Right? So here from A to B, additional cost. If you decide to move from A to B, you will incur 300 additional cost. If you not move, you can avoid this cost. You can avoid the cost. If you have to bear the cost, if you are not take the decision, you can avoid the cost. So this is what? Relevant cost. This is relevant cost. Already incurred this 1,000. Relevant or not relevant? To move from A to B, this 1,000 is relevant or not? Here relevant cost, how much? Only 300. When you take decision, if decision is yes, you will incur 300. If you are not, you can avoid 300. So that is incremental cost. Relevant. That is relevant cost. You see what does incremental cost mean? Opportunity cost mean, you know that opportunity cost, the foregone. When we have very limited options with use of scarce resources, we have to choose one. Out of 2 options, we have to choose one. Or out of 3 options, we have to choose one. When we choose the best one, we will foregone, right? Another. So that benefit we foregone by selecting first preference. That the cost is called opportunity cost. It is a cost which is incremental as to relevant management decision, though more frequently the incremental cost include the variable cost. Normally it includes the variable cost. Fixed cost may be also included. Fixed cost mean from A to B. So either you use A or B, you have to use the same machine, right? Same machine. So no fixed cost. If you switch to from A to B, right, you have to include a component, separate component that cost 500. This 500 also fixed cost. So the parts, it's not direct material, it's not a direct labor. It's a component of the machine. It's a part of fixed cost. So that time it's additional fixed cost. When you go from this point to another point of decision, there will be an additional cost. Why this cost incurred? By taking decision. If you not to choose that decision, you can avoid that cost. So that is what additional cost. That's also incremental cost. And you can read this example by yourself, and right, you can read and understand what is relevant cost, what is opportunity cost. Now we move to sunk cost. So there are irrelevant cost. Sunk cost, irrelevant mean there are some costs which are not taken into considered for taking any decisions. Sunk cost, so all past costs, already you did the cost. Past costs which have been already incurred. Example, development costs have been already incurred. So you purchase a land, you will develop that land, right? So already you did. Now you have a developed land. Now you are going to decide. You are going to produce X or Y from that land, product X or Y. When you take X or Y, or whether to go for production process or not, you have to consider is only the marginal cost, not the cost already incurred. Say you have spent a big amount of money to develop that land, so that cost cannot be included in their uh, decision making. That is sunk cost, the past cost. Committed cost. So already you agreed to do something, right? Committed. Say you agreed to pay 10,000 every month to certain person. You already committed to that. So this cost also cannot be considered. The cost which has already been agreed to pay as per decision taken in the past. Right? This also you already decided in the past. That cost cannot be considered. Notional cost. Some costs are non-cash. For example, depreciation. Depreciation. It's cost, but there is no cash movement. That is a notional cost. The cost which has not been incurred actually, right? Not actually. It's mean what? Um, depreciation. Depreciation, even though we consider as a cost, it is not actually not a cost. And the cost estimated for reflecting the cost of using resources, say you right what so you're working here and you charge some salary for you, emotional cost, right? And you run your shop in your own building, right? You assume that you put the target, you assume so one rent, right, for yourself. So that is also notional cost, but it become an opportunity cost. Say you have an option, you can lend this, right? You can rent out this shop building to third party and you can earn 10,000 per month as a rent. But now you run your own shop. This time you can consider this 10,000 rent as opportunity cost. So the opportunity cost is okay, relevant cost, but you assume. So normally no one requests this land for, no one requests your building for rent purpose. If nobody asks you, there's no opportunity cost. So that you can't put artificial uh, rent to your calculations for decision making. Absorbed overhead cost. Already fixed overhead. Already you committed. You already met. You already purchased the fixed cost. Right? This fixed cost are absorbed based on the unit and number of hours. It's already fixed. So therefore, the absorbed overhead also considered as a irrelevant cost. So here there are some examples to understand what is relevant cost and irrelevant cost, but we will focus on most important areas for your study assessment, right? And qualitative factors in the decision making. What are the factors you consider when you make decision? When you go for your assignment, you can see we are working on C2. Look at C1. Investigate the factors that impact on financial decision making by framing the decision context. One short-term pricing, output pricing decision, and long-run investment. We will discuss the long-run investment and identify key financial factors. Key financial factors like risk, such as inflation, taxation, exchange rate, demand, price, sensitivity, capacity limit, cost structure, working capital, while noting any material stakeholder impact. To attend this, you may consider these factors: qualitative factors, decision making, availability of money, inflation, employees, availability of employees, the customer base, competitors, suppliers, feasibility, political pressure, legal constraints. So these are right. These are some qualitative factors. In the assessment, they're asking some sort of other financial sector. This is part. Right. Now we come using the above relevant cost short-term decisions. Short-term decisions are taken to the following nature. Right. So we will discuss limiting factor, make or buy decision, accept or reject, shutdown, extra shift. So we are not discussing these things because we can, right? We can read yourself by, I will share this material, you can read, but in your assessment focusing on limiting factor and make or buy decision, right? Yeah, they are focusing on limiting factor and make or buy decision. First, we will talk about limiting factor. So what does it mean, limiting factor? Have you studied linear programming and a simplex method? Have you heard about these things, linear programming and simplex method, in your earlier studies? Did you study it? Okay. Okay. So limiting factor, right? Companies always try to maximize their profit. Maximize profit. But to maximize the profit, so there are a huge demand, right? You may have huge demand. So you are producing a certain product called product X, right? So when you go for market, your production capacity, say 10,000 units, 10,000 units. But in the market, you have demand only for 6,000 units. It's only 6,000 units. Then can you produce all these 10,000 units? Is it possible to make all these 10,000 units? Your machine, your existing machine and resources able to produce 10,000 units. But in the market, you can't sell 6,000 units in the current scenario totally. So it's limit you. It limit your production. You limit your decision. So how many units you can produce maximum? 6,000 and 4,000 units we can't produce. It's idle. It make you an idle. Right. In the market, the product of X, the market 6,000 demand. The machine can produce 10,000 units, but the machine operator or the particular raw material shortage, right? So raw material shortage. So this time, can you produce all 6,000? Is it possible? No, you can't produce all 6,000 because even though your capacity is promising you to 10,000, but the material, say for example, you have a digital printer, digital color printer, right? So you can produce whatever the amount. But the thing is, the market you couldn't find the toner, color toner in the market. You have only one toner in your hand. By using that one toner, you can produce only say 5,000 copies. Only 5,000 copies, the toner. But in the market, there are 10,000 demand or 6,000 demand. But we can satisfy only 5,000 because there's a shortage in the raw material. And the machine operator, even though we have raw material, machine, and the demand, sometime the labor, for example, uh, no, the X-ray. You take X-ray in a hospital, you may have X-ray equipment and there are a lot of patients, right, in a hospital, but you don't have technician or radiographer. It's called radiographer, right, in your area, in your region, or the radiographer visit your hospital in a particular time, in a month, within a month. So labor shortage, technician shortage, so that even though you have machine, you have patients, you have a lot of demand, but the limit to your profit maximization is what? The labor, right? The limiting factor may be the market demand. So in the market, you have very limited number of demand, and the raw material may limit your production capacity, and the labors, sometime machine hours, say during the power cut season, during 2022-23, huge power cut. The machine can be operated only 8 hours. Normally the machine operates 8 hours per day. Now you can run the machine for 3 hours. Right? So by operating these 3 hours, only you can produce a certain number of output. So here the machine hours also very limited. So limit your profit making capacity. So here this kind of things may limit your production capacity or profit making capacity. That time, how do you make decision? How do you make decision? Say a company, a particular company produces product X, Y, Z. Out of these three product, how many unit of X produced, Y produced, Z produced, right? So this kind of decision they have to make. So this is called limiting factor analysis. Now we move the main factor, right? Let's see the limiting factor. The main factor that limits the business activity. The main factor that is limit the business activity. For example, it may be raw material, skilled labor, machine capacity, market demand, etc. When limiting factors are existing, a product first which maximize the contribution for maximizing profit should be chosen. So the decision criteria, which product or which limiting factor give us more profit, more contribution has to be chosen first. First, the necessary steps. First, identify the limiting factor, right? Second, contribution per unit. Find the contribution per unit for each product. And for each product, compute required quantity from limiting factor, right? Then we have to find out how many hours or how many units of limiting factor we need, and then compute contribution per limiting factor, right? Contribution per limiting factor. Plan the production based on the sequential order of highest contribution per limiting factor, right? Then we have to rank it. We have to rank them, and finally, maximum production should be the maximum demand for the relevant product, right? So in this method, we will do this. Let us read this question. Okay. Variable cost. Variable cost per unit of product X and Y of ABC company are as follows. Right? Direct material 20 and Y 30. Direct labor hours 5. Right? So 1 hour, right? Per hour it has to be paid 5 rupees. And total cost of direct labor is 10. So therefore, how many hours it requires to produce X? How many hours? How many hours requires to produce 1 unit of X? How many hours it requires? To produce 1 unit of X, how many hours it requires? How many hours? Labor
2
hours.
hours. 2 hours.
How many?
2.
Labor cost is 10. Labor cost is 10 rupees. Per hour 5. Then X requires 2 hours. X requires 2 hours. How many hours required Y per unit? How
3
many
hours.
hours? 3
3 hours.
hours. 3 hours. 15 divided by 5. So it requires 3 hours. It requires 2 hours. And variable overhead. So very careful. Here there is no fixed cost. All of them are variable. All of them are variable cost. Right. To produce X, it costs 50. To produce Y, it requires 7. Variable cost. Variable cost. Right. Selling price unit of X and Y are 80 rupees and 100 rupees respectively. So this is this is 80, this is 100. The number of labor hours available for the month of July is 18,000 hours, right? Labor hours, direct labor hours, available labor hours 18,000. Expected sales for the month of X and Y, X 3,000, Y 5,000. Right? Prepare a production plan which maximizes the profit. So now you know the scenario. Please read this again. Please read. Please read this question. It's very important because in assessments, it's targeting mainly. Read carefully. Okay, now I take a copy of this. I move here and paste it. First step, we have to find out the contribution, right? Contribution equal, right? Selling price and variable cost. Here, product X, product Y. Selling price, this is 80, this is 100. And variable cost, X is 50 and Y is 70. Then how much contribution? X 30 and Y also 30. Right. So both of them are give us equal contribution. Right. Second step, we have to find out the limiting factor. Find the limiting factor. What is limiting factor here? Which make you limit? Right. Before that, we will find the profit. Right. Right. There's no fixed cost. Right. Okay. And how many units they can produce? How many units they can produce? 3,000. This is 3,000. This is 5,000. Selling price unit, right? Then how much profit total contribution they can make? Total contribution, how much? 90,000. Then this one, 15. 1, 2, 3, 4. Right? So altogether, how much profit they can make? How much profit they can make? Almost 240,000 rupees profit they can make. Right? 2,000 profit. They can make 200,000. But is it possible to make this 240,000? Is it possible in current scenario? Is there any limiting factor here? Is there anything limit?
Yes.
Yes. What is that?
Restricted to 18,000.
Yes. Available labor hours is 18,000. Before that, before we decide is it actually is limiting factor or not, let us calculate how many hours it requires. We know that to produce 1 unit of X, it requires 2 hours. And to produce 1 unit of Y, it requires 3 hours. In the market, we have 3,000 unit of X and 5,000 unit of Y. So therefore, how many hours we need? Here 6,000 hours and here 15,000 hours. Altogether 21,000 hours it requires. 21,000 hours it requires to make this 240,000 profit. Right. The available labor hours is 18,000. Available labor hours 18,000. Here we have only 18,000. Then how many hours shortage? Shortage of hours, how much? How many hours? Shortage?
3,000 hours.
3,000, no? 3,000 hours. 3,000 hours limits our capacity. Limit our capacity. So this time, the company has to decide how many units of X and how many units of Y has to be produced in order to make profit, in order to maximize the profit. In order to maximize the profit, how many units of X and how many units of Y it requires. How do we do this? First, we have to find out the contribution, and then we have to find out what's the limiting factor, and next we have to find out what is the contribution for limiting factor, right? What's the contribution for limiting factor? Right. Now, let's see. Right. The contribution, X contribution and Y contribution. X contribution 30, Y contribution 30. This contribution and limiting factor is labor. Limiting factor, labors. How many labor hours X requires? 2. How many labor hours it requires? 3 hours. Now let's see contribution per limiting factor. How much is for 15? 15 rupees. Here 10 rupees. Here we can earn when you utilize the hours, labor hours for X, it will promise you 15 rupees. When you use the same labor hours, it will give you 10 rupees of Y. Then what is your first preference? You allocate the labor hours for which product, X or Y? First preference?
X.
X. When we go to rank, so it promises us highest number of X, highest number of contribution, and this is second, right? Can you allocate all 21,000, all 18,000 hours to X? Is it possible? Can you allocate all 18,000 hours?
No,
No. Why is that?
they need only 6,000 hours.
Right. We have demand in the market. We have demand for product X. Product X demand is 3,000 and Y 5,000. So we can, so it is limit, our production is limited by the market demand, so that we can allocate all, right, out of this 18 hours, we can produce 3,000 units of X, and each requires 2 hours. So therefore, we can utilize only 6,000 hours for X. The balance, we have 12,000 hours, right? We can produce only 3,000 of X. And to produce the balance, we have 12,000 hours, and to produce 1 unit of Y, right? It requires 3 hours. It requires 3 hours. Then how many units we can produce of Y using 12,000 hours? How many units we can produce?
4,000.
4,000. And 12,000 divided by 3 equal 4,000. Why we can produce 4,000 units? So the product's mix is, in X we can produce 3,000 units, and for Y we can produce 4,000 units. When you do so, profit will be, the contribution will be, so each unit it produce 30 rupees X and 30 rupees Y. It's a contribution. We already calculated. Yeah, 30 rupees contribution and 30 rupees contribution. Here, then now how much profit will be? This is 90,000, and here only 120,000. Altogether, they can produce only 210,000. Maximum profit, the maximum contribution they can make is 210,000, right? If there is no limiting factor, right? If it is unlimited demand, we can produce all, right? All labor hours. Say we can produce 9,000 X, and we can say if it is unlimited demand in the market, so each X give us 30 rupees, and by using 18,000 hours, we can produce 9,000 unit of X. Then 270,000 profit we can make. But the market demand is limit our capacity, and also there are two, right? Here we have two limiting factor. One is market demand and direct labor hours, right? Is it clear? Is it clear? Any doubt, please let me know. It is basic. So if we have make mistake in fundamentals, we can't go forward. Any doubt? Anything else? Okay, if we have no questions, any questions here? Okay, let's move. If you have any unclear area, please let me know, please. Okay. Thank you. Right, the second question, if the fixed cost, for the month is 110, compute the profit for the month of July. So how much profit? Here, are we able to generate 210? The fixed cost is 110, and we can make profit of 100,000. We can profit 100,000. Yes, it will give you profit 100,000. I will share this, right? I will share this book with you. Right. The third question. Third question will be, if the capacity of obtaining extra labor determine the maximum rate of salary payable per labor hour. So what the question is, right? Here we have 18,000 hours now, 18,000 hours. But we need 21,000 hours. We need 20,000 hours. We require 3,000 hours. We require 3,000 hours. Shortage 3,000 hours. You can enjoy, you can get extra labors when you pay more, right? The current rate per labor hour is 5. Current rate is per labor hour 5 rupees. If you increase the labor cost, labor charge, you can hire the laborers from outside. The question is how much the maximum rate of salary payable per labor hour? How much? How do we calculate? Any idea? Any idea? Right. So that here, when we look at the current contribution, right? Contribution is 30. The current contribution is 30 because selling price is 100 and variable cost is 70, out of which the labor cost is how much? The labor cost is 15. Labor cost 15. Labor cost is 15, right? Per unit of Y, you need 3 hours. You need 3 hours. By paying 5 rupees per hour, you're able to make 30 rupees contribution. 30 rupees contribution. Profit, 30 rupees contribution. and there are chances of covering your cost up to 30. You can, it gives you a gap. It gives you a gap of increasing 30 rupees, increasing 30 rupees per product Y. It requires 3 hours of labor. If you can pay how much? You can pay 10, right? You can pay 10. You can additionally you can pay 10, maximum 10. So already you pay 5 rupees and you can pay 10 per hour additional. Then you can go maximum 15 rupees per labor hour. If you pay 15 rupees per hour, how much it cost? How much it cost? 15 rupees into 3, it could be 45. So it's become 45 and it is 30, no change, and it's 25. It's become 100. It's become 100. Yeah, you can go up to maximum 100. The selling price equal variable cost. Then contribution equals 0. Contribution equal 0. So therefore we can go up to 15 rupees. Is it clear? Is it clear?
Yes.
Or do I want to repeat? Do I need to repeat? No need, no? It's clear. Okay. Since the aggregate demand for product X can be completed, the extra labor are obtained and should be used to fulfill the demand which cannot be fulfilled by the product Y, because in the market we have 5,000 units of demand, but we able to produce only 4,000. So we need to produce only 1,000 units. 1,000 units. To fulfill this 1,000 units, we require each 3. Therefore, it needs 3,000 hours. The present rates pay for the direct labor hour can be increased further by 10 rupees as receiving a contribution 10. Contribution for limiting factor by product Y, right? By using the direct labor per hour, presently obtained 5 rupees paid per hour. Accordingly, the maximum rate of salary payable per direct labor hour is 15, as already they are paying 50, and contribution per limiting factor for product Y is 10. Altogether 15. As such, direct labor hour is obtained on the payment of 15 rupees, and if it is used for product Y, the contribution per limiting factor could be 0. The maximum point we can go for contribution equal to 0. If we go above contribution, it will give you negative, which means the cost is higher than the variable cost is higher than the selling price. If we do so, it's no meaning of running. It's not a charity. It's not a charity, or it's not a government. On government and charities are producing or providing product at the cost above the selling price. Right. CSP company produces 3 products. Now here we have 3 product scenario. CSP company produces 3 product A, B, C, and the selling price and variable cost per unit is respect with this product as follows. A, B, C. Selling price is given, variable cost are given, direct material cost. Here it's given 50 rupees per unit direct labor. So it requires 200. Then how many units it requires direct material? How many units? For A, how many units of A? How many units of direct material to produce 1 unit of A? How many? How many? 200 rupees material cost. Per material, you need 50. Then how many units of material used? How many?
4 units.
Yes, 4. 200 divided by 50 equal to 4. For this, 7. For this, 14. Right? It's a very basic things. Right. I take the screenshot on this. Question is here. Right. Expected sales per month as follows. A 300 rupees, B 450, C 250. The directors of the company carry out a policy of producing at least 150 units. Right. So there are they have a policy of producing at least 150 of each, even though they are facing loss. They are facing loss in the market by producing this product, even though having a loss by which enabling to supply to the market in order to meet the competition. The quantity of raw material could be obtained per month is the available uh, quantity of raw material is 6,250. The monthly fixed overhead 75,000. Question is, advise the best suitable mix of these 3 products. Right? How we do this? This is the question. Read or think about this problem for 1 minute. Read, at least read this. At least read. Right. Now we'll work on this. The condition is we have to produce at least 150 of each unit. Then to produce A, B, C, the material, direct material we need here for A, we need 4 units. here 7 units, and here 14 units. 14 units. Right. So the minimum, right, at least for 150, no, 150 they have to produce. To produce 150, uh, how many raw materials should be used for A? How many? 600. 600 units A consumed. B consumed how many? B, please cooperate me quickly. How many? So at least the company should produce A 150, B 150, C 150. So we have to allocate the limited resources for that product. So that
1050.
we, yeah, 1050. 1050, isn't it? Am I right?
Yes.
Am I right? This one?
2100.
Okay, right. So totally it requires how many hours? How many units it requires? Quickly. 600 plus 1050 plus 2100, how much? Please quickly calculate.
3750.
Hmm?
3750.
3750, right. Available units 6250 available. This is available. This is essential. So that we have only 0, 0, 5, then 5 to only we have only 2500 units of material. These 2500 material should be allocated based on the maximum. Right. Now, for the demand, we see the demand. Here, how many demand? Expected sales for the month. Expected sales. Here, demand is 300. This is 450. This is 250. Then essential, we already satisfied 150. Essential already allocated. This is 150, 150, 150. So the market demand, available demand, Here we can maximum produce 150A. We can produce 300B and 100C demand, available demand, because already we satisfied 150 of each. Right. Now let us look at the contribution. First step is to find out the contribution per unit. Here we need selling price. Selling price. How much selling price? Selling price 600. It's given. Selling price 600 and 1200 and 1600. And the variable cost. Variable cost. Here, how much? 200, 300, 460. Yes, here it's variable cost. 460, 870, and 1650. 1650. Then see the contribution. How much contribution? Contribution 0, 4, 140, right? Here 0, 3, 330, and here 0, 5, 950. Is it right? I think it's lost now. It was. Sorry, it's a loss. The selling price 1600 and variable cost 1650. So a loss of 50. Okay. So now, what is the contribution? So limiting factor, we need limiting factor per unit. Limiting factor per unit. Here we already found 4, 7, 14. Then contribution per limiting factor. How much? How much limiting factor? So divide 140 by 4. We will get 35. Nice. We'll get 35, 35, 47, 14, and 3.1, 3.57. Right. This is contribution per limiting factor. When we order, right, when we rank it, here it provides us highest contribution per limiting factor. Highest contribution per limiting factor. So therefore, we have to produce B first, followed by A or 2. Third rank is loss. So it is advisable not to produce. It advisable not to produce C because it gives us loss. So we rank B first. We rank B first. This is 2. This is 3. Right. So here we have available demand 150, 300, 100. Now we decide. First we produce B. We have maximum demand. Each give us 300. Right. It requires how many hours? It requires how many hours? Right. B requires 7 hours. B requires 7 hours. B requires 7 hours. In the market, it has demand 300. It has the market 300. So we allocate as much as possible all available limited factor like material. So 2100 units of material. But available material we have 2500. So totally we have 6250. So these are the compulsory 150 compulsory. So we already allocate 600 A, 1050 for B, 2100 for C. So we already allocated 3750. So balance we have only 2500 units. 2500 units. So we have 2500 is available. Then balance we have 004. Only 400 units available, right? So now we allocated 2100 for this B and we have balance. We can allocate 400 for A. So we know that each unit requires 2. Each A requires 2 limiting factors. then we divide by 2, right? We divide by 2 and it can produce only 200. Let's see how many demand we have. So in the available demand, it's 150 available demand. Sorry, right? It requires 4, right? It requires 4, not 2. This is rank, no? This is rank 4, right? Each of A requires 4 hours, so therefore it should be 100. It should be 100, right? So what is the product mix? What's the product mix here? A, B, C. We already produced 150, 150, 150. Plus we already produced 300 B. So therefore it satisfies all demand 450. And A, we produce 100, this 100. Then they can produce 250. And C cannot be produced additionally, so 150. Altogether, so this is the product mix. A 250, B 450, C 150. This is the product mix. Right, is it clear? Clear? Okay, right, fine. And then we move to right. Second question. Okay, let's verify the answer. Yes. B 150 plus 300, 450. The total contribution. The question is right. The quantity of raw material could be obtained 650 and the monthly fixed cost 75,000. So now we calculate the contribution and profit. Here we produce only how many? A 250. So each provide us contribution equal. A give us contribution, right? Contribution 140. 140. B give us 330 and C give us 50 loss. 50 loss. Then how much profit we can make it? 250 into 140. Right here, 250 into 140 equal 35,000 and 450 to 330, 148, and it give us loss 7,500. So total contribution we have, contribution is 136 and the fixed cost would be 75,000. So therefore profit for this product mix is 101. Right, 101 is the profit mix, ideal production based on the constraint. Right. Let us move to make or buy decision. Make or buy decision. Either buy the product from outside or make the product inside. So make or buy decision. In your assignment, it also one of the main part. You see here, make or buy decision. Here, this point. Make or buy. That also we check. Make or buy decision. Here, the relevant decision is taken in comparison with the relevant cost of the product which manufactured within a firm and supplier's price. The relevant cost of the product which manufactured within the firm is included incremental cost. So incremental cost, right? Variable cost always an incremental cost. Extra fixed cost. Extra fixed cost. Sometime the existing machine is not sufficient to produce the product inside, right? So to make the production process, they have to fix separate parts. So we have to consider this cost of fixing extra parts is called what? It is extra fixed cost. That is extra fixed cost. And the opportunity cost, right? Opportunity cost mean sometime, right? Sometime you may use this existing machine for a particular product, right? Your normal product. Now you are going to use this machine, existing machine, to a new product. Then if you use this machine for a new product, then you have to stop. You have to stop some of the uh, existing product. So by stopping these, you may have some sort of loss. Loss mean by using this machine for this product, you may unable to produce the existing product. So that is called that is what the loss, right? That is the loss. That is called opportunity cost, the missing profit. And actually, it's a profit. It's a missing profit. It is opportunity cost. The opportunity cost is that product is manufactured within the firm and it's lost the opportunity to produce other product, right? Product by using such resources and thereby lost the contribution, right? But when you use the existing machine for the new product, so that you are considering make or buy from outside or make internally, it's become the cost of product concerned. Before make relevant financial decision, the following qualitative factors, right? It's a qualitative factor should also be considered. What are those? First, suppliers creditability, such as capacity of supplying the relevant product on time, the right quality of the product, right? Not only the financial aspects, make internally or buy outside. For example, Toyota manufacturing its engine and the body. Normally, they purchase tire from outside. Now, the Toyota company may decide whether we are going to produce the tire internally within their facility or buy from other external supplier. So this is a decision. So when they do this kind of decision, first they have to look at the supplier's creditability, whether the reliable customer, whether the customer able to supply their product on time with right quality. And what is the period of time? What is the period of time the present price remain unchanged? Right now, at the time of contract, supplier convinces us to provide the product at a cheaper price, than we produce. Once we make the contract for a period of time, they ready to supply at that price. After that, they may tell you a different stories to increase the price. So that in that instances, you have to be very careful. The persistency of the price unchanged, how long the price is got unchanged from the supplier. So these two are the major qualitative concern of the suppliers. But we have an example. So it come up with a lot of things. So it's better to start with the new class, right? It's a little complicated. We have to calculate the variable for this is question number one, question number one, question number two, question number three. Question number one is okay. Well, then question number three, so there are a lot of things. So it is information to the relevant to the question number three, in addition to this information. Right. So now we stop here. If you have any questions, please. If you have any doubts and gray areas, please let me know. I can explain, please. Any questions? Okay, be careful about your assignment. So they will send you assignment to the UK people. They will review, so that we have to pay serious attention on that. Okay, if you have no other questions, right, I can share this. I can share the material today we discussed. Please WhatsApp me. I will share it, please. Otherwise, I will forget. Please WhatsApp me. My number is this Note 76. I can share my screen. This is my number. Please WhatsApp me. I will share it. Okay, I have shared this to members. So kindly circulate among groups. Okay. Okay. Yes, I said to you. Okay, let's see by next week. Thank you.
Thank you.
Thank you.
Thank you, sir.
Okay, good night. Bye.
Thank you, sir.